Well, folks, I am preparing for a recession. In today's video, I'm going to go through a lot of data, a lot of information in charts and things like that I've never shared with you guys ever before. And we're going to go through some of that today and exactly kind of what I'm looking at in this video, okay? But essentially, I'm preparing for a recession, and we'll get into all that. I've let everybody know that's part of my team, everything like that. Like, expect, ad rates to be low for a while. Expect, like Hungry Bowl. I'm making sure we run a really tight budget so we don't go under in this situation, and just really watching ourselves because based upon everything I'm seeing, I think it's a pretty darn high likelihood that we're going to go into a recession. I think the main question is, how deep of a recession is it? I will say the financial system's in a much better place right now than it was in, let's say, the '08 recession. That's good. But there's a lot to be worried about. There is truly a lot to be worried about when it comes to this recession and kind of everything I'm looking at. So yeah, I hope you guys enjoy this as always, and just me kind of being honest about, what I actually see going on out there and those sorts of things, okay? So this all started, even my thought process around potentially having a recession was at the very end of December. So, 3 weeks ago or so, 4 weeks ago, Elon Musk had said this on Twitter. He said, predicting macroeconomics is challenging, to say the least. My gut feel is around the spring of the summer 22. And at that moment, I just I saw that and I was like, wow, Elon, he expects a recession. Like, Elon's a pretty smart dude. Like, you don't become the richest person in the history of the world without being, kind of know what's going on, right? So I thought it was interesting, but I didn't go too in depth at that time. I was just like, wow, that's a pretty big statement from a guy that is the most popular, most known business person in the whole world, right? So I was like, okay. So I just put it in the back of my mind at that moment. And what we've seen is a clear, massive deterioration over the last, let's say, 2 or 3 months in so much, okay? So what we're looking at here, this is a Google Trends, okay? And I always say Google Trends is our friend. And if we pull up in the United States of America in the last 5 years, the search term auto loan, what we find is we are the lowest in the past 5 years, okay? If you want to talk about a bearish signal for autos going into the springtime and into the summertime of 22, it would be a situation where nobody is looking for an auto loan, okay? Now remember, Elon Musk must be seeing something out there or multiple things out there that make him say, I've got to go on Twitter and to all my followers, and they're all going to see this, and everybody in the business community is going to see this. There's got to be something going on for him to say, you know what, I'm going to go out and put my head out there and say, I think there's a recession coming very soon. Not like 10 years from now, but like very soon, right? Spring or summertime. And so what I believe Elon Musk was seeing was demand coming in from Model 3 and Model Y, new orders dropping off. And what we've seen from Google Trends is that's exactly what has played out very recently. Model Y and Model 3 are the lowest they've been all in the entire past year. And so Tesla's likely going to put up good numbers this past quarter, in this upcoming quarter. But after that, there's a high probability they start missing growth estimates in a major way. And when you have auto loan search term tanking down, it's a really bad thing. Mortgage loan, you might think, well, maybe it's just auto loans. No, the search term mortgage loan has dropped to about the lowest it has in the past 5 years here very recently, guys. I mean, we went on this epic run from, let's call it mid 2020 through basically through about the summertime of 2021. We went on an epic run. It was great. Mortgage loans. People were really out there buying houses, looking for mortgages, things like that. And very recently, over the past, 2 months or so, we've dropped off a cliff. Like, look at that. I mean, the decline is just massive. And I spoke to my main mortgage lender and the person I looked for guidance in the real estate market, and he said that it's a tough market out there. It's been super competitive, and he said a lot of these mortgage companies are starting to even lay off some employees and things like that. And yeah, it's not a good look when you're falling to your lowest you've been at any point in the last 5 years, and you're expected to keep up the great work. No, that's not happening when things like this are happening, right? If we look at home loan, that search term, same exact situation. We are the lowest now recently that we have been in the past 5 years, right? We went through such a bullish cycle for home loans, mortgage loans, auto loans, and now this is just coming down in a massive way. And remember, these are extremely important things for the GDP. These are extremely important things for people's wealth and what is likely about to happen to their wealth, okay? So this is extremely, extremely concerning, okay? Next up here, this might even be more concerning than what we just looked at. We're looking at now personal savings rates in the United States of America from June 2015 through through October of 2021. Now, the problem is this always lags. So what we saw is, we have to look way back at October numbers. The personal savings rate was falling off a cliff as it was, right? And back in October, we fell all the way down to 7.3%, which is in line to where we usually are. Now, I would almost guarantee you, if we were to see the numbers as of today, as of me recording this, which is January 21st, 2022, I would say there's an extremely high probability we are likely at a 5%, or dare I even say a lower than a 5% number on personal savings rates. When you see what's going on with this trend, and then when you say, okay, we just had a massive holiday season and those sorts of things, and there's this massive inflation going on, there's no doubt in my mind that likely right now we're at a 5% or under a 5% number for personal savings rates, which is not good at all. That's a disaster. That's no bueno. That's all I have to say about that. When you look at kind of where we're not in a very good place as it is, but when you start talking about falling to a 5% number or under a 5% number, that's a whole different ball game from being at let's say 6 to 9%, which is where we usually are or have been for the last number of years. So yeah, people are, if your personal savings goes down massively, you're not going to have that type of money to go out there and spend and go buy the newest iPhone and go buy the newest iPad and the newest ... right? That's just the way it works. When you're flush with cash, like we were for a while when the stimulus was getting pumped out there and everything was and people couldn't spend money. When you're flush with cash, all of a sudden it's like, hey, let's go buy a new house. Let's go buy a new car. Let's go buy the newest iPhone. Let's go buy this and that, right? But if all of a sudden you got no dang money, how are you going to go buy stuff? Like, it's common sense, right? And so this is extremely concerning. I wish we had an accurate number as of January 21st, 2022 right now, because I would almost guarantee you we're a 5% or number. And that's extremely worrisome if you're thinking about, could we go into a recession here, okay? Now, Mr. J. Powell, okay? Mr. J. Powell, he tries his best, okay? And respect. Yeah, he's got a tough job, I will say that. But his new nickname from me is Mr. Lag. And the reason his nickname is Mr. Lag is because this man has lagged this entire time in everything, okay? So if we go back to essentially, early 2021, what was I saying? Well, I was saying I am seeing out in the real world, based upon people I actually talk to that are in the real world, that run businesses, we're seeing inflation. Now, if we go back to early 2021 and even into mid-2021, I'd listen to Jay Powell talk, and he was acting like there was really no inflation. The reason being is he was looking at lagging indicators at the end of the day. He was looking at lagging indicators, and he's not really in the real world, and he doesn't talk with people that are really in the real world, okay? And so all of a sudden now they're looking at like, oh my gosh, inflation's gone insane because now the numbers have really started to hit, and they're seeing all these numbers. And the worst part is they're going to see this upcoming quarter, and there's going to be even worse inflation. The numbers are going to see, because that's looking back at October, November, December. So that's the even worse part. And so they're going to say, oh my gosh, there's so much inflation. This is crazy. There's so much inflation, so much inflation. And what is going on in reality is things are deteriorating underneath the surface when it comes to actual economy in a massive, massive way. And so they're so focused on, hey, how many times are we going to raise rates this year? Everybody's predicting now 4 to 7 rate hikes this year. And I'm out here saying, I said in a video yesterday, I'm going to put my head out there, I would be amazed if they raise rates even twice this year. And I think there's a pretty decent probability, based upon the trends we're seeing, and unless those massively reverse all of a sudden, there's a very high probability they have to lower rates in 22, okay? And that's going to catch the Fed and everybody, completely off guard in this situation because he's been a lag on all this stuff. They've completely lagged time and time again because what they have to look at is they look at always lagging indicators. They're not looking at what's going actually on. The Fed's not out there looking at Google Trends data for auto loans and home loans. They're not out there talking to the local mortgage company who's saying, man, they aren't really coming in the way they were coming in, I'll tell you that much. They're out there talking to the local car dealership. They're not out there doing that, right? And so nothing catches their attention until it gets so bad that it catches their attention, right? The Fed doesn't know that small cap stocks have been crashing for months. They're kind of like, whatever, that's just small caps. And now all of a sudden it's every stock. And it's like, oh, you can't miss it now, can you, Fed? Okay? And so, unfortunately, they've lagged this whole situation, and I'm extremely worried that they're going to end up raising rates maybe even potentially 2 times here early in 22, maybe in the spring and the summer. And that would be so detrimental because we already have a disaster on our hands. Mortgage loans, auto loans, everything's falling through the floor. Inflation's gone crazy. But if they raise rates, it's like this, okay? I thought of this analogy recently. The Fed, imagine you're in the middle of the forest, okay, and you got this little backpack, and you got big container, you got like a gallon of water, and you got 7 protein bars, and you're like, oh man, I'm lost in the middle of the forest. It's going to take me 7 days to get back to wherever I need to get to, right? And so you could say, okay, I'm going to make a decision. I'm going to eat all 7 of my protein bars right now, and I'm going to drink this whole gallon of water right now. You could do that, right? Anybody that has a brain should be like, that's a stupid idea because by tomorrow you're going to be super thirsty and super hungry, right? So don't eat all your 7 protein bars right now and don't drink all your water right now, right? But the Fed, that's essentially what they've done in this situation. They pumped up the stimulus way too much. They pumped way too much money out there during Rona. It obviously made assets go crazy. It made everything go crazy, including inflation. And now we're in a situation where they've eaten all their protein bars and drank all their water, and now they're acting like we got to survive for the next 7 days on nothing. And here we are in a situation where we're likely going to need a lot of their help to get out of this situation, or it's going to get really, really ugly. And I am not sure if they are prepared to change the course fast enough. In all due respect to Joe Biden, I don't know if he's really up for this task of making massive changes and doing it very, very quickly. I think he could be another one of those that likes to look at these lagging indicators and be like, well, in the last quarter, ... And it's like, dude, don't worry about last quarter. You need to worry about what's going on over the next quarter and the next quarter after that. The last quarter means nothing. And with Jay Powell, I worry about the same exact situation because that's what we've seen consistently from him, is lagging on these things and looking backwards rather than, hey, let me look a little bit forwards and what's kind of likely going on here underneath the surface. Because if you wait too long in these situations, woo! It gets way ugly, way fast. And then you have to respond coming from behind. And I can tell you, then you're lagging. And if you're lagging a quarter or two, that can be the difference between going into a huge recession or not a huge recession, okay? So that definitely is worrisome. Now, the market's obviously starting to fall massively. We're likely on pace for the worst January in the history of the stock market. The NASDAQ is now down, pushing close to 11% down year to date. So yeah, we'll see how things shape up over the next the last 5 to 7 trading days of this month. But this is likely going to be potentially the worst stock market in the history of the stock market for the month of January. And so that will catch the Fed's attention. The problem is they could end up chalking that up to, it's just market volatility or something like that. When really, I think what's really starting to go on here is actually outside of normal market volatility, and I think it is big money starting to look and starting to see a lot of worrisome signs out there. And when stocks have been trading very rich, which we've gone over Yardini research a million times, and we've looked at large caps, and I've been speaking about this for 3+ months, if not 6 months now. Large cap stocks have been trading very rich. And when you're in a market where large caps are trading very rich, and all of a sudden you end up in a situation where potentially, we're not going to meet any of our numbers when it comes to these companies, when it comes to GDP, when it comes to anything, and maybe you're about to go into a recession, and maybe job losses are coming. And keep in mind, wages have been, wages workers are commanding have been very, very high recently, and If companies aren't earning the revenue to pay for those employees, job cuts come. Or, what comes is non-hiring, right? And so this is a situation where we're seeing the stock market start to get very ugly, very fast. And what we were experiencing, when the small cap stocks were falling and the growth stocks were falling, right? And everybody laughed at us like, oh, you're in the small caps, you're in the growth stocks, ha, 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 you're getting what you deserve. What we're seeing now is everybody is starting to get hit, and there's almost nowhere to hide. Amazon stock, I was looking at Amazon stock. Amazon stock's now down $500 a share, over $500 a share from where the stock was in July of 2020. Okay, and so now the stock market is starting to catch everybody's attention, and is going to even more so the more it goes down. Now, the next part of the process is if everybody's losing money in the stock market's downtrending, right? Well, what's next? I'll tell you what's next after that. Real estate. Real estate lagged in the whole pandemic, okay? So essentially what happened is in the pandemic, stocks came back the fastest, right? And then real estate lagged by about 6 to 9 months in terms of real estate started to really ramp up, right? And what we're seeing now is stocks start to flush to the downside over the past 3+ months, and even more so now, right? And so likely what's coming is a big real estate reset starting probably in the spring or summer. And when you look at what's going on with home loans, mortgage loans, those sorts of things, that's definitely worrisome. And what drives real estate at the end of the day is really two core things. Mortgage rates. Well, mortgage rates, I talked to my mortgage lender. He says mortgage rates have jumped 1% in the past 30 days. That's worrisome. What also drives the real estate market pricing is jobs. Because if people have great jobs and they're paying awesome, right? And they can afford that house and they can afford to buy the next house and things like that, right? However, if job losses start coming, companies start cutting jobs, wages start going down, amount of hours start going down, all of a sudden, what starts happening? Those homes aren't worth as much because people can't pay that much, okay? And so, that's where you can end up in a double situation where mortgage rates are going up and potentially job losses come, and you're getting eaten away by inflation. That can get very, very ugly very, very fast. And so don't be surprised. Here's the thing, guys. This is not sustainable, okay? That's not sustainable. What you're seeing in front of your face, real estate prices being up 35%, 30%, 27%. I own a house in Arizona, okay? I own multiple houses in Nevada. I'm the first to tell you that's not normal activity. 20, 30% rises in average homes. Some of my properties have appreciated 50% plus in the past 12 to 18 months. That's not normal, okay? That's not normal, and that is unsustainable. That is a freak situation, and it's better to be lucky than smart, I guess you can say, because I bought a lot of real estate properties in 2019 and 2020, and so I'll say I'm more lucky than smart. I'll just put it that way when it comes to real estate. This is not normal. I'm smart enough to say that's not normal activity. Real estate going up 20, 30+%, not normal, and that is I would say something you should definitely worry about as we get more into the spring and the summertime when it comes to these real estate prices and everything that goes along with that. When real estate's going up, it's great for companies like Home Depot and Lowe's and remodeling companies and companies that build backyards and all those sorts of things. Because people are like, oh man, we got so much equity in our home, or our home prices are doing so good. Let's go ahead and put some more money into this. Let's repaint the home. Let's put in a pool. Let's do a new backyard. Let's do a new front yard. But all of a sudden, when prices start going down, all that activity goes away. Look at what people were trying to do to their homes in 2008, 2009, 2010. People weren't doing anything to their homes 2011. You know why? Because the prices were down. So it's like, wants to put money? If anything, people were foreclosing and short selling, right? It's like, who wants to put money into their house? If they're in that type of situation. And never mind that, the last component of this is, what about the people that have just bought houses the last 3-6 months or are going to over the next 3 months? If real estate starts going down, next thing you know, we could end up with buyers that are underwater in their houses. And that's when you in stocks, everybody expects to go underwater, right? If that's like, you expect that. In real estate, most people don't expect to go underwater, or if they do, it's a very small amount. What if people start going underwater 5%, 10%, 15%? Gosh, what if we start pushing 20%? That's a whole other subject. I'm hoping we don't go to those sorts of places for those folks' sake. But it is something I worry about. It is something I think about. And I don't think it's out of the realm of possibility for something like that to happen. Could we have a real estate crash where prices go down 40, 50%? I think that's fairly unrealistic. But I don't think it's crazy to imagine a situation where some of these more recent buyers could go down 10% on their properties if things keep playing out the way they're playing out, right? So, that's some more food for thought there. Then you have cryptocurrency. Bitcoin's all of a sudden starting to fall. Bitcoin was at 43K yesterday, and it's at 38 now. And so all of a sudden, Ethereum fell off a cliff, and almost all these cryptos just fell. And here's the thing with crypto. More people are more invested in crypto in any time period in history, okay? That is something factual, we know. And when it comes to crypto, the Fed doesn't even give this attention. This is another one kind of like small cap stocks where they're like, whatever. That's just a market doing whatever the market's going to do. But what they don't understand is how many people have a lot of money now tied up in Bitcoin, in crypto. And if all of a sudden their crypto portfolio, even if it's only, let's say 4% of their entire net worth, drops a ton, they're not going to feel quite as wealthy, right? And so this is another kind of food for thought. And there's the thing that's the scariest about crypto market is nobody's there to save the crypto market because the Fed's not there to do that. The Fed, they're there to try to save the economy or jobs or the stock market or even real estate. But I can tell you the Fed's not really there to save Bitcoin. That's just the honest truth. Biden's not there to save Bitcoin. And so that's kind of the scariest thing for me when looking at the crypto market is, when things are great and when economic times are great, hey, this is awesome. But when all of a sudden you start going through a troublesome time, oh man, that's when it's the scariest. And what you have going on right now is the wealth effect is starting to leave. So when everybody's getting wealthier, right? When stocks are going up, when crypto's going up, when real estate's going up, when used car prices are going up, right? I mean, as crazy as it is, people have been making money off used cars. I mean, that's just extraordinary. And so when that's going on and everybody's getting wealthier and wealthier because stocks are going up, real estate's going up, crypto's going up, it's great because people have more money to then go ahead and invest in other things if they want, or they have more money to pull out and then go spend. They feel richer, they feel wealthier because their account says ... They go on Zillow, their home value says ... They pull up their crypto portfolio, it says ... They pull up their Moomoo account, which by the way, get your 5 free stocks from Moomoo. That'll be pinned comment down there. Get them before they run out, okay? Because who knows how long somebody like Moomoo is going to do those 5 free stocks, so make sure you guys take advantage of that while they still got a deal like that going on. But when the wealth effect starts leaving people have less confidence, right? I've lost, in terms of my wealth, I've lost 7 figures. I've lost 7 figures in the last 3 months. So guess what? I'm a lot less wealthy than I was 3 months ago, which makes me not as confident, which makes me not as willing to spend money out there, right? You don't see me going out there and balling out and I'm saying I'm going to go get another Tesla and I'm going to go get a new fancy watch and I'm going to go get another house. No, when I just lost 7 figures in the last 3 months, I'm not feeling as wealthy. So my confidence goes down. My amount I'm spending out there in the economy goes down, right? I got the same iPhone I had last year. I'm not going out there to buy a new iPhone right now. I just lost 7 figures in the last 3 months. You think I'm feeling so confident that I'm like, let me go buy another iPhone? Heck no. I'm not going out to do that. I'm like, my iPhone will do just fine right now, okay? And so once you have this wealth effect leave, which is a scary thing, people's confidence goes down and the amount of money people have to spend goes down as well. And so you end up in this kind of pickle situation where it's like, okay, this is why the stock market, this is why the government, the Fed, everybody, make sure you subscribe to this channel if you're not already. This is why the government, the Fed, everybody, they want a rising stock market over time. They want a rising real estate market over time. Because as those go up, people get wealthier. They have more confidence. They're more willing to go out there and spend. And if all of a sudden prices start dropping, people's confidence comes down, people's amount of money they have to spend goes down, everything goes down, it hurts the economy. That's when you get into people making less money and potentially job losses, which is the scariest domino to fall. And let's hope that doesn't happen, because if that happens, then you're in a full-scale recession at that point in time. And then you're into something deeper than, maybe just people are pulling back on autos and home loans and things like that. Then all of a sudden you're into, oh my gosh, people are pulling back on everything, and they're strictly going to needs-based items and needs-based things at that point in time, okay? So that's why I'm preparing for a recession. If a recession doesn't happen, perfectly fine. As far as me, I'm always staying invested in the market. I always buy stocks regardless if there is a recession or if there's no recession, or if I'm expecting a recession, if I'm not expecting a recession, if there's good economic times, bad, anything. I'm always a buyer of stocks. I'm always looking for deals out there in the market, and I'll buy stocks. That's what I always do. I don't go all the way to cash or something like that. I buy stocks. But that's why I'm preparing for a recession. Much love as always. Hope you guys got value out of this video, and have a great day.